Welcome to part 3 of the Investing for Beginners course. If you're following the financial news, you'll probably hear phrases like, the stock market is going down, or this investor is beating the market, or maybe the stock market is too expensive. There is a reason why all these headlines use the term the market or the stock market, and it's quite important to understand it. We are still in the first section of the course, Understanding of the Stock Market, and this video is dedicated to market indices. I'll explain what an index is, talk about the popular indices. I'll explain how to invest in an index, why indices are viewed as a reference point for investors, and what they can teach us about the overall market. As always, before we start, if you want to learn more about investing and you are interested in managing and growing your own capital, please visit my website for more advanced courses. You can also join my investing community on Patreon, where I share my portfolio, bring up new investing ideas, summarize earning calls, and discuss various topics related to investing. You can find all the links in the description below and in the pinned comment. Okay, so what is an index? A stock market index is a statistical measure that tracks the performance of a group of stocks. It's basically a number that represents the price change of a group of stocks. Usually, an index will track the performance of the top public companies of a certain country. For example, the primary stock market index in the UK is the FTSE 100. It tracks the performance of the 100 largest companies listed on the London Stock Exchange. The primary stock market index in Germany is the DAX. It tracks the performance of the 40 largest and most liquid companies listed on the Frankfurt Stock Exchange. Probably the most popular stock index in the world is the S&P 500 index. This index tracks stock prices of the leading 500 companies in the US. Per country stock market indices are created for a main reason to track local market performance. It can indicate the strength of a certain economy, although it may not always be a good indicator, as we will see later. These indices can help investors to decide whether to invest in a certain country or adjust the exposure of the portfolio to certain countries. It can influence economic policymakers regarding the economy of the country. That is why, when we hear the term the market, it usually refers to the index that tracks the performance of the popular stocks of that country. The most popular index in the world is the S&P 500 index. This index tracks the performance of 500 of the largest companies listed on stock exchanges in the United States, and it is widely regarded as the best indicator of U.S. stocks. For many different reasons, which we'll discuss in the next video, this index is the most popular index in the world and probably the best performing one. One important feature of an index is how it's built. The S&P 500 index is a weighted index, meaning that the performance of the index is not calculated by simply averaging the price changes of all 500 companies it tracks. Instead, each company's influence on the index depends on its market capitalization, how much the company is worth. Relatively large companies like Apple and Nvidia are representing about 7% of the index and will influence the index much more than smaller companies. This type of structure makes the top 6 companies in this index to represent 30% of a 500 companies index. This unproportional influence on the index can come both for investors, most times as a benefit but sometimes as a disadvantage. Nevertheless, it's important to recognize the large influence of a small number of stocks on the entire index. Besides the S&P 500 index, there are a few also very popular American indices. The Nasdaq Composite Index tracks the performance of all stocks listed on the Nasdaq Stock Exchange. It includes a wide range of companies, particularly those in the technology sector, and is considered an indication for U.S. tech stocks. The Dow Jones Industrial Average, often referred to as the Dow Jones or simply the Dow, is a stock market index of 30 prominent companies listed on stock exchanges in the United States. It's one of the oldest and most commonly followed equity indices. This index includes large, well-established companies with a history of strong performance and stability, and the Russell 2000. This index measures the performance of the 2,000 smallest companies listed in the U.S., and it's often considered a benchmark for the small-cap segment of the U.S. equity market. Okay, so far we learned what an index is and why stock market indices exist. We also mentioned that the S&P 500 had great results in the last decades and is considered widely popular for that reason. More advantages that we also mentioned are the low risk associated with investing in an index, and also the simplicity relative to picking individual stocks. So the obvious question will be, how can we invest in an index? One very simple way is buying an exchange-traded fund, also known as an ETF. We'll talk about ETFs later in the course, But for now, I'll just say that an ETF is a type of investment that trades on a stock exchange, just like a stock, only it allows you to invest in a certain theme like an index, which is basically a basket of stocks, bonds, or commodities all in a single so-called share. You can buy units of such an ETF, and the price of these units will move together with the underlying asset. The term underlying asset refers to the asset that the ETF follows. The underlying asset of the S&P 500 ETF will be the S&P 500 index. The underlying asset of an oil ETF will be the oil price. Since the S&P 500 is a very popular index, there are several ETFs that you can buy in order to track the performance of the S&P 500 index, and that is often called investing in the S&P 500. Here are two of the popular ETFs of the S&P 500 index, SPDR ETF trading under the symbol SPY, and the Vanguard ETF trading under the symbol VOO. In this chart, you can see the two S&P 500 ETFs I just mentioned, and the index itself. As you can see, the index and the two ETFs are practically moving together, and that's why you see basically only one line during this time period. It means that the two ETFs are following very closely to the index. In order to invest in S&P 500 index, you just need to buy units of such ETF. Another important characteristic of the S&P 500 is that it is considered as an investing benchmark. As I mentioned before, the S&P 500 had great results in the last decades and is considered widely popular for that reason. So as investors, we should ask ourselves, why should we invest in individual stocks and spend our time and effort in order to pick the right stocks if we can easily invest in an index fund and enjoy the good returns? The answer is that we need to invest in individual stocks if we want better returns than the index, and that's the meaning of beating the market. If I'm investing in stocks and I can't beat the market, there is no point making this effort, and that's also why the S&P 500 index is commonly referred to as a benchmark we strive to beat. The indices can also provide useful insights about the overall market. They provide indications about how expensive the markets are in general. You see, about once in a decade, the stock market enters a bubble condition. A bubble is a term used to describe the stock market where many companies are valued at incredibly high prices with no fundamental justification, meaning the stocks are going up in high percentages while the earnings of the companies don't. We can see it if we look at the price-to-earning ratio of the whole index. We will talk about price ratios more extensively later in the course, but in simple words, if the prices are relatively high and the earnings are relatively low, this ratio will be high. And by that I mean high compared to the average value. That's exactly what happens during bubbles. This ratio is rising, and it can be a good indication. A famous stock market bubble was the dot-com bubble. This stock market bubble that occurred during the late 1990s, primarily involving internet-based companies and hence the term dot-com. During this period, many internet companies with little to no revenue or profit were valued at very high prices, leading to a speculative frenzy. If we look at the price-to-earning ratio, also known as the PE ratio of the Nasdaq index, we'll see a considerable spike around the year 2000. This particular bubble was a tech stocks bubble, and the Nasdaq, which mainly consists of tech stocks, was the best indicator of the bubble. If we look at the performance of the Nasdaq index, we'll see that the extremely high PE ratio of the index predicted perfectly that the tech stocks valuation is too high, and indeed, the index dropped about 80% during the following 3 years. Another example will be the COVID-19 stock market bubble, which occurred during 2021. Due to various reasons, the price of many stocks went up much more than their earnings, and an unproportional increase in the stock price was evident in the S&P 500 index PE ratio. In this chart, you can see the PE ratio of the index was rising to 40, while the historical average is between 20 and 25. And in this case, also, the index PE ratio predicted that the overall stock market is too high, and the index dropped about 24% during the next year. Sometimes it can indicate the opposite, that the overall index is priced very low. For example, after the Great Financial Crisis, the PE ratio dropped to 13 during 2011, which is considerably below the average. Since then, the index rose 160% during the next 7 years. So, as you can see, the indices are quite important for investors for several reasons, and they are also a popular investing method. I hope that I managed to explain what a stock market index is and that we're gradually building the understanding of the stock market. Thank you for sticking till the end. If you like the content and want to support the channel, please like and subscribe and see you in the next video.